Disclaimer. Trading financial instruments carries risk. This material does not contain investment advice, nor should it be viewed as a personal recommendation, or an offer of, or solicitation to trade in financial instruments. Past performance is not a guide to future results.
Hello everyone and welcome to a new ITFX video. My name is Gonzalo Cañete, and in this case, this video once again, it's here to give you a quick and good review of recap of what happens during the second week of May. So get ready. I bring to you today data, charts. We're going to talk about currencies. We're going to talk also about corporate. We're also going to talk about the global situation of the markets, especially commodities, gold, oil, and we're gonna also review what is the situation with the dollar, Federal Reserve. We got actually a few comments this week, very interesting comments, for even three different members from Federal Reserve, all of them going in the hawkish direction, all of them trying to scare the market, but still, as we predict in our previous reports, market is resisting super well because market is now watching the macroeconomic data, which in the case of the United States is not good macroeconomic data, and it's precisely what Wall Street needs to keep rolling forward and moving and recovering the main levels lost during the previous weeks. Just to give you a quick update or review, let's say, market was falling. Let me share the screen with you. Market was falling mainly by the words from Jerome Powell, who actually say what we were announced in these reports with months in advance. What we did was the Federal Reserve cannot cut interest rates because the inflation is moving in zigzag. We explained this in our previous report. You can go and take a look to our previous videos and see what exactly it was our reasons to know in advance what will be the decision done by the Federal Reserve. Now, we also say in our previous 2 weeks that, first of all, the slow growth rate from U.S. economy compared with expectations, which was 1.6 over against the 2 point something growth rate expected, plus summarizing also that in addition with the negative labor market data, the increase of the unemployment rate, the highest non-farm payrolls unexpected, all of these things I say on our previous report probably was the perfect reasons to consider the Federal Reserve eventually gonna turn the policy or the posture and start to gonna be more flexible, and it's exactly what the market did. Now, I did a kind of summary of all week. Let me see what exactly I left it. I think it's here. So we're gonna go point by point to recap the whole week with the most important event happens. And again, I'm gonna talk to you about currencies, I'm gonna talk to you about commodities, I'm gonna talk to you even about geopolitical events, because the last week, the week we are closing right now, ending in 10 of May, it was actually the week where when Xi Jinping, the president of China, was actually traveling through Europe, visiting Serbia, visiting France, visiting Hungary, and not stopping in Germany, which is one of the reasons where we believe the trade war is still active. Remember, President of the Treasury United States, Janet Yellen, was actually traveling like a month ago to China to just begging and request to please calm down the exportation of electrical vehicles to the rest of the world, and is one of the important points of the trip. It was actually promote and announce the investment done in Hungary to open new stations, new fabric to produce electrical vehicles in Europe. Now let's go to the points. First of all, full screen, and let's start to jump from one thing to another and see everything in detail. Thomas Barkin expressed less confident in rate drops, but expect high rates to slow the economy and bring inflation down to 2%. This is the mantra we have been repeating for the last few months, and now officially is the posture of Federal Reserve. After all, this is what they are saying, and it's exactly the position I was sharing with you since December when they announced for the first time this. The reaction of this kind of comment should be increase the strength of the dollar, which is something that eventually was happening, but as you can see, has been forming the last few days, this lateral movement here. But still is super strong and is going in line with probably a target of 107 points dollar index. This means the relation of euro dollar gonna be lower. I mean, it means if dollar index is touching 107 points, obviously euro dollar gonna be quoting below 107 most likely, and also the equity market probably gonna start to find certain resistance to keep moving forward. All right, so far it is not happening. Dollar is still keeps still strong and remains strong, but still is not pulling down the equity, which is actually recovering the 5,200 levels in the case of mini SP500, which is the one you got in the screen right now. Now let's keep moving. Japan, yen value decline and US dollar pass 140. Actually, it's even worse. By Friday, this was based on the report done from Monday. Okay, by Friday, the dollar yen was actually getting close to 156. As you can see, Japanese traders and mostly currency traders are getting in a kind of panic mode because the yen is getting weaker and weaker. And recently, I think it was on Tuesday or Wednesday, we got a few comments done by one of the most important traders in Japan saying that his view, his position, his opinion on this is like the government should not intervene at all the currency, which it was also causing certain movements upwards on the dollar yen. Market, SP500 trade about 5,200 points. US 2 years bond yield fell to 4.8 and euro dollar rail about 1.8. Let's take a look to those assets to see how exactly they finished the week. We say SP500, you already saw it, is actually breaking up about the 5,200 points, which is good for the equity. In the case of bonds, fixed income, we can see that it's still in 4.8%. The returns, the yields of this bond, 2 years bond in the United States. And remember, any bullish relation in this market is discounted high interest rates. Any drop in the market is discounted lower interest rates. Therefore, this movement was caused by bad macroeconomic data in the United States, which is probably related with the slower growth rate on the GDP and also drop on the unemployment, or actually a rise on unemployment rate to 3.9 from 3.8 and high non-farm payrolls. It makes a lot of sense, but so far the market is keep moving to those level, which is the barrier of 5%. As you can see, this resistance here is a barrier of 5% and it's attracting the price constantly, like magnetic effect. So any debate about the interest rate cuts of Federal Reserve is gonna get reflected in this chart. Okay, so follow that chart closely for the future. What else we got? A slight improvement so in PMI services data, but German factory orders and trade balance weakened. We saw that German factory order was improving, but is still in negative territory, which is not good news for German industry. As you can see, because I said with you many times already, the growth rate from Germany is completely gone. Has been more than a year moving in this kind of lateral minus, positive, minus, positive, minus, positive, minus, positive in a zigzag. This is some kind of worry because it's the main economy in Europe and it's not going well. Still, what is funny is check that equity markets in Germany are going super high. Look, boom. How this makes sense? No idea how this makes sense. Obviously, I think it's a market that is supported by Central Bank of Europe and also obviously artificially inflated by big hands, because otherwise it doesn't make any sense that capital is flowing to German assets when the German economy is actually in recession. Now let's go to the next day. In this case, we mentioned the previous day Thomas Barkin from Federal Reserve of don't remember which state, but in this case we got Minneapolis Federal Reserve president, which is Neil Kaskari, state that he doesn't rule out rate hikes if it's necessary. Take a look on this. Hike rates if it's necessary. So it's not even saying we are not cutting interest rates. It's even suggesting that they could increase the interest rate, which is the last thing you want to hear. This, in other circumstances, will cause probably a drop on the equity market. It didn't. SP500 was still pushing forward and pushing higher, and you can see the market was recovered. So it seems to be completely neutral. You see, but market's ignoring him. This is the report I did. You got the whole report in details on our blog. If you want to go to all details, I'm posting this every morning, so you can see here all details. But so far, the comments, the summary, it's just no reaction from the market. I was also mentioned that still dollar index is moving in the right direction, is gaining strength and going to 107 points. Germany industry production data contracts 0.4%, so minus 0.4%, better than expected because it was expected to contract even 0.6%. So bad results, but still better than expected. Now, attention with this. Sweden accumulate 4 consecutive quarters of GDP contraction, potentially pressuring Riksbank to cut interest rates. Because by Tuesday, we were expecting the interest rate decisions from the Central Bank of Sweden. And I think I opened somewhere here. Yeah, I show you the situation of Sweden. You see, this is the growth rate of the GDP. And this is the situation of the currency. We got euro against Swedish koron. And as you can see, it's moving forward to what I believe at some point is going to reach, break out the new maximums, because this is a new record. Okay, it was the weakness point of the currency in years, right? And it's probably going to a new record of 12.50. I was also mentioned that on X. On Tuesday, on Wednesday, I don't remember. The last week, I just quote this in Spanish, but the last week we saw a contraction, important contraction on the GDP of Sweden, 4 quarters in negative results, and Riksbank could be pushed to. This is the situation, right? And this is the interesting thing. If the Riksbank is actually cutting interest rates to help the economy to get out from the recession, it's going to also push up the relation euro-Swiss koron and also against the dollar, which is the worst scenario because obviously inflation going to rise in Sweden if your currencies keep dropping. Against the main currencies is rising because, as you can see, euro against Swiss koron is just moving up if the currency is getting weaker and euro is getting stronger. Same pattern with dollar. It's not good. So if they cut interest rates to help the economy, they're gonna put in troubles the currency. All right, that's the main factor I would like to highlight on this case. Equity. Apple present new iPad Pro models with AI-oriented and latest M4 microchip, which is apparently 50 times faster than M2. So in this case, what was the result from Apple? I think I also shared the Apple charts. Let me take a look. Yeah, it's this one. And I was just sharing on I believe last week on Friday, we also mentioned that in order with the new presentation of devices by Apple, which is, the main income from Apple is coming from retail market selling mainly the iPhone. So we were just paying attention to the iPad because it could also increase expectations of growth of this company. And it seems to be good because as you can see, it's a gap here. So the price was rising 183 from 160 something by the time we make the first report on last week. We say, well, it's a strong support here and with a strong resistance, previous resistance here. Therefore, it's a good level if you got apples to hold them. If you are considering to buy apples, could be an interesting point to at those levels last week with certain stops below $160, and it works really well because it was $183 at the moment. What else? Microchips. Okay, geopolitical. Israel threat to carry out its operation on Rafah, which by now it's a reality. As you've seen, during the week it was actually an intervention. Tanks were seen based on the videos of Israel army. Tanks have seen in Rafah, and therefore, obviously, they have been. Which was the main concerns of the United Nations and even United States, who say that if that happens, they will not send any weapons to Israel. Regardless that it happens, actually. Commodity markets, oil, OPEC Plus policy will drive the future of oil. Will Brent expect to break through above $90 per barrel? Why? Because we also mentioned in our report on 8th of May, we also mentioned that they are planning to continue to extend the cut on production unless until the third quarter of this year. So it wasn't good news neither. What it was, I don't know what it was, but I guess somewhere. I don't remember what exactly we mentioned this, but somewhere we're talking about the commodity in this report. Or maybe on this is the one from 8, maybe on the one from 9th. We talk about OPEP and the oil. No, not here. This is weird. Yeah, it's here. It's I know, oil. Well, anyways, it's a summary of the report, so you can find more details there. But commodities, crude oil markets continues for the 4th-week lows, while gold remains strong but stable below $2,300 per ounce. Again, this situation, my friends, has changed. Now, if we take a look on oil and on gold, oil is rising back again. Now it's getting a little bit, you see, it's just twisting back. But this morning was pushing again to about $84 per barrel. Now it's twisting to 83, losing almost $1 per barrel right now. But it seems to be, again, a very important point to see. At some point, probably this area is going to work as a kind of support, and the natural movement going to keep moving this up and down, breaking, falling against to the main channel. If he's respecting the channel, it's probably going to come back to the main levels around $88-90 per barrel again, which is what we mentioned on the report, based on the reduction of the production, cut on the production supply for the coming months. Now, we almost finished. Bank of England unlikely to reduce interest rates with potential impact on the pound and London stock markets. It was published by Thursday morning, and actually what happens is the interest rates didn't change at all in United Kingdom. We also got a comment from Wednesday to Thursday from Susan Collins on the top of comments from Kaskari, and on the top of the previous ones we have seen the third member from Federal Reserve making hawkish comments, saying hinted that rates may need to stay at 2 decades high for longer. Again, a new comment trying to scare the market. The market is not responding. The market, once again, has been rising really nicely the last few days on the equity market, on Wall Street. Federal Reserve, China. Trade balance publication show improved exports and imports above forecast, which is again good news, because by 2023 our main concern was see how the trade balance of China was getting smaller and smaller and in a contraction, and we afraid of global recession, considering the European Union is not doing well, China, and then United States. It was probably the only from these 3 main economies, United States, European Union and China, 2 of them seems to be in trouble. Right now it's just Europe. China seems to be doing well, and the numbers from China seems to be fine. Geopolitics, EU Commission President and French President to warn Xi Jinping during the trip of Xi Jinping in Europe to warn him about unfair trade practices. And again, this was published from our report yesterday, and it was, if you thought that China's President Xi Jinping visit to Europe will not be politicized, surprise. European Commission President Ursula von der Leyen and French President Emmanuel Macron are expected to warn China President Xi Jinping about the unfair trade practice and urge China to play a greater role in resolving the Ukrainian conflict. Okay, they keep sending weapons to Ukraine, but they say it's China the one who need to take steps to find a solution to the problem, which is ironic and funny, both. What else? UK economy. We got finally on Friday really good numbers from UK economy. Economy of UK growth 0.6% the first quarter of this year, ending the shallow recession and boosting Prime Minister Rishi Sunak position for the UK elections. It was growing above expectations. It was actually good results. Let's see if we can take a look of the growth rate of United Kingdom. It's still in negative, so it's not updated yet. But the numbers, it's updated yet actually on the it's not updated on the summary, but it's updated here. So as you can see, this has a very good news, because since it's the faster growth rate since summer 2022. Okay. What else? Market strained dollar, potential for European bonds to outperform US bonds, and inflation concerns for Europe. And this was a very interesting point. If you take a look, German bonds, for example, are paying approximately half of the returns paid by US bonds. If you take in consideration that officially the Central Bank of Europe position right now is to cut interest rates because inflation in Europe has been dropping farther than in United States. You got the inflation rate in Germany is 2.2, while United States is 3.5. So obviously it's much nicer. If you take a look, it seems to be more harmonic, right? The drop on the inflation for Germany, and therefore they're gonna decide to cut interest rates probably. If Europe is cutting interest rates and United States is telling to you openly they're gonna hold the interest rates for longer, the relation on euro dollar should be bearish. Should be actually the market should be dropping from the current levels. And if you take a look on this chart, maybe you believe so, maybe you don't think so, maybe it's up to your opinion, right? But if you take a look from a further distance, you see the whole forest, you will see more clear where we are. And yes, in this case, I believe the market actually is gonna keep dropping even below the parity and even going to lower levels. I think that's the destiny of euro dollar, and it matches completely with the macroeconomical situation that the central banks are saying. Federal Reserve gonna hold interest rates, is paying better even on the bonds. European Union gonna cut interest rates, and therefore euro gonna become cheaper and dollar gonna become stronger. That's a bearish relation in euro dollar pair. Japan household spending rose 1.2%, falling risk of persistent inflation. This is another thing that I believe, based on macroeconomical data, could affect the dollar yen, because if we are also mentioned already that the monetary policy of BOK, Bank of Japan, is not clear. For example, they announce interest rates rise, hike the interest rates, and actually what they say after that announcement, it was, okay, we're gonna do this, but still we're gonna keep buying bonds at the same amount of bonds on our expansion monetary policy. So therefore, it's not reducing the kind of liquidity they inject into the market, regardless if they touching the interest rate. So the effectiveness or the results of this measure are useless if you keep injecting liquidity on the market. And actually the Japanese bond didn't react. It's still quoting at ridiculous yields like 0.20%, 0.30%, 0.70%, but below 1% constantly, because that's the rule and that's the policy. Therefore, we can expect from dollar yen that the market keep moving forward, and unless they really take serious this threat for the yen, otherwise the dollar yen gonna keep rising even about 160, which is worrying somehow for the future of Japan, because obviously the importation is gonna be super expensive. Gold sharp rise to $2,370 per ounce, with Chinese investors seeking refuge in gold amid geopolitical turmoil. Not only that, I give you more details in today's report here. Let me read you the whole thing because it's very interesting. The situation with gold right now. Gold. Once again, gold has risen sharply over the last 24 hours. Let me show you the chart. Super interesting. Look, this movement. So nice. Boom. Okay. And obviously, it seems to be completely targeting $2,400, which is here per ounce. Okay. Now, what was the report saying? It is trading at $2,370 per ounce and seems to be moving strongly towards the new all-time highs near to $2,400 per ounce. Amid geopolitical turmoil and the war in Gaza, but China has played an outsized role in driving the rally this year. And here's the interesting details. With Chinese stock market weak for the last 2 years and the real estate sector in China at risk, as you probably know by now, China's investors seems to have a clear asset to take refuge in, which is gold. If your equities are not working, if you cannot buy stocks, you cannot buy your equity, you cannot either invest on properties, because obviously the real estate sector it's trying to find a kind of de-escalation of the leverage they hold for many years. What else you got? Gold market. Because obviously, and this is something we also highlight on the report today, not only the retail investors, but only Chinese central bank has also been a major buyer of gold, adding to reserves for 17 straight months to diversify away from US dollar dominance assets. You got all details here. And this is my report from this morning, okay? What else? I think that's the key factor. Geopolitical growing, the trade tensions between the US, Europe and China, with European firms ranking China as a lower investment destination. And also, this is the bad size. Europe is not investing in China. It's in the lower levels of low investment in China. But it doesn't mean China is not investing in Europe. Take a look. However, based on Euroactive, what it is? Okay. Chinese President Xi Jinping is visiting Hungary after stops in France and Serbia. China is the major investor in Hungary, and the visit is expected to yield further investments, which are timely as Hungary has missed out of European funds. Chinese automaker BYD plans to establish its first electrical vehicles production facility in Hungary, following investments from other Chinese automakers in Europe. The shift to electrical vehicles gives China producers an opportunity in the lucrative auto sectors as European automakers struggle in this transition. They are still considering how they're going to face these new changes in regulation, in cars ownership, 15-minute cities, how they call, and so on. And then China is moving further. That's why, again, President of Treasury of the United States, Janet Yellen, got a flight to China to discuss with Xi Jinping the options they got to reduce the offer on the international markets of electrical vehicles done by China. And like Elon Musk said, they're going to ruin our competitors. They're going to ruin the West countries' competitors of electrical vehicles if they keep moving at that speed on electrical vehicles market. Okay. I think that's all. We have taken a look on all assets while we were reviewing every single topic. See you next week. And if you like these topics, please don't forget to subscribe. Contact me if you want to actually see anything in detail. And if you want to request any particular topic, you can do it through the email or through comments on this video. So please subscribe, give me a thumb up if you like it, and see you in the coming videos. I think where is the subscription slide? It's here. Okay. Thank you, take care, and see you in the coming ones. Bye bye.